Usually when you look at a company's income statement, right, and you see top line revenue jump, like 190% in a single quarter.
Oh, yeah. That is massive. It's the absolute dream scenario.
Right. You expect to hear, I don't know, champagne corks popping in the boardroom.
Yeah.
Because it's the kind of explosive growth that makes retail investors just, sit up, take notice, and hover their fingers right over that buy button.
Exactly. I mean, a near tripling of sales usually signals that you've crossed this critical threshold, going from a struggling startup into a scaling enterprise.
It's the ultimate shiny object. But then you scroll down a few lines on that very same financial report, and suddenly the champagne goes completely flat.
Yeah, the hangover kicks in real fast.
Right, because the profit margins haven't just shrunk, they've entirely inverted. You're bringing in almost triple the cash, but you are somehow losing more money on every single item you sell than you were a year ago.
It is the absolute definition of a financial optical illusion. I mean, you are looking at a much bigger engine on paper, but it's suddenly burning more oil than fuel.
Yeah.
It literally costs more to keep it running than the horsepower it actually produces.
And tearing into that illusion is exactly what we are doing today. Welcome to the Deep Dive. Today we are breaking down the Q2 2026 earnings call for Barfresh Food Group. If you're looking them up on your app, the ticker symbol is BRFH.
Right.
And we are doing this with a very specific mission, which is filtering out the Wall Street spin, avoiding the dense jargon, and figuring out what these numbers actually mean for the regular retail investor holding the stock.
Yeah, we really need to separate the headline hype from the operational reality today, because with this specific company, the gap between that revenue number and the reality on the actual factory floor is just a chasm.
Okay, let's unpack this. For those who aren't familiar with the name, Barfresh is a company built primarily around beverages. We're talking their twist and go, ready to drink smoothies, their easy pour bulk beverages, juice concentrates they sell under the brand WRLZ, and juice pops.
Yeah, and their bread and butter, like the absolute core of their entire business model, is the education channel.
Right, the schools.
Exactly. They sell heavily into school districts. Kids need smoothies with their lunch, and Barfresh provides them.
Which seems like a great gig.
Oh, it's an incredibly lucrative and reliable market if you can actually lock in those contracts. I mean, school districts are the ultimate B2B consumer play.
Because they buy so much, right?
They buy in massive bulk, yeah. And they forecast their needs predictably, like months in advance. And because they're government-backed entities, they actually pay their bills on time, which is huge.
But the barrier to entry has to be high, right? I mean, you can't just walk into a public high school cafeteria and start hawking smoothies out of a cooler.
Far from it. No, you are dealing with strict USDA nutritional guidelines. You've got these really complex bidding cycles that only happen once a year.
Oh, wow, only once a year.
Yeah, so if you miss it, you're out. Plus, there are rigorous distribution requirements. When a school district puts a product on their menu, they are making a promise to thousands of students and parents.
Right.
So if you win that bid, you're locked in, which is great. But you are also on the hook to deliver flawlessly every single time.
And to supply those schools, you actually have to, make the product reliably. Which brings us to the numbers that immediately jump off the page in this Q2 report, because they are just openly fighting with each other.
Oh, the contradiction in this earnings report is staggering when you lay out the math.
Let's hit the core data for Q2 2026. Revenue comes in at $4.7 million. That is that massive 190% year-over-year growth we just talked about. 4.7 million compared to just 1.6 million in the second quarter of 2025.
Which on the surface looks like a massive win for management.
Right, but then we look at the net loss, $1.9 million. That's compared to an $880,000 loss in the prior year.
Yeah.
So they more than doubled their net loss while nearly tripling their revenue.
Yeah.
And the real gut punch here, the metric that should make any investor just pause and take a breath, is the gross margin.
Absolutely, because gross margin is the pulse of a manufacturing business. It tells you exactly how efficiently you are turning raw materials into finished goods before you even factor in things like marketing or, executive salaries.
So in Q2 of 2025, Barfresh had a pretty healthy gross profit margin of 31.1%.
Which is solid.
Yeah, means for every dollar product they sold, they kept about 31 cents to run the rest of the business. But fast forward to this quarter, Q2 2026.
Yeah.
And that gross margin has fallen to a negative 3.2%.
A negative gross margin. I mean, that means the fundamental unit economics of the business have just broken. It literally costs them more in raw materials, direct labor, and factory overhead to make and deliver the product than they actually charge the customer for it.
To translate this into everyday terms, it's like buying a bigger wallet, only to realize there's a giant hole at the bottom of it. You're shoving way more bills into the top, but they are falling out faster than you can zip it up.
That is the perfect analogy.
I mean, how does a company nearly triple its revenue, but absolutely obliterate its profit margin in the process?
Well, what's fascinating here is that the top line growth is essentially purchased revenue. It's not organic growth of their core business at all. The headline number is basically wearing a mask.
Wait, purchased revenue. So you're saying that 190% jump isn't organic growth. They essentially just bought a top line number.
Exactly. That 190% jump wasn't because schools suddenly ordered 3 times as many Twist and Go smoothies. It was entirely driven by Barfresh's recent acquisition of a company called Arps Dairy.
Okay, the dairy acquisition. I saw that in the notes, but I didn't realize it accounted for that much of the pie.
Oh, it's the whole pie. Out of that $4.7 million in total quarterly revenue, $3.2 million of it came directly from Arps Dairy.
Wow.
And what is absolutely crucial to understand is that $2.9 million of that Arps revenue was just the sale of raw and processed milk.
Wait, so a smoothie and juice company is now suddenly generating the vast majority of its revenue, just acting as a traditional milk supplier. They are basically the milkman now.
They are the milkman. And the fluid milk segment is a really low margin, high volume, highly commoditized business. I mean, milk is milk.
Right.
You are competing on fractions of a penny. It is a completely different operational beast compared to selling a value-added branded product like a Twist and Go smoothie.
Where you can command a premium price for the formulation and the brand name, right?
Exactly. So when you fold millions of dollars of commoditized milk revenue into Barfresh's income statement, it aggressively distorts the top line. It makes the company look significantly larger overnight.
But it's empty calories for the bottom line. It pads the revenue, but doesn't feed the profit engine.
Bingo. If you strip away the Arps dairy milk sales entirely, Barfresh's frozen beverage and food segment, so the legacy products, the actual core business that investors care about, that only increased by 9% year over year.
9%. That is a massive reality check.
Yeah.
We go from a screaming 190% growth narrative to a very modest 9% reality for the core brand.
And it gets worse, because even that 9% growth included some minor contributions from Arps. The organic growth of the legacy smoothie products was incredibly muted this quarter.
Okay, so that perfectly explains the revenue illusion. They bought a milk business that juices the top line. But it doesn't fully explain the margin collapse, right? Because even if milk is a lower margin business, it shouldn't push the overall company margin into negative territory. Selling milk might only make you pennies, but it shouldn't cost you dollars. So why did the margin go negative?
Well, that leads us directly into the operational reality of this acquisition. To understand the margin collapse, we really have to look at the physical mechanics of what was actually happening inside that Arps Dairy facility.
The factory that couldn't.
Yeah, exactly.
Let's look at the guidance the CFO, Lisa Roger, gave on the earnings call. She walked through their adjusted EBITDA and laid out some very specific, very painful negative variances.
Right.
She cited a $1.8 million negative impact purely from higher processing spend at Arps Dairy.
Just let that number sit for a second. $1.8 million in unexpected processing costs for a company that only generated $4.7 million in total quarterly revenue.
That is wild.
It is a massive disproportionate expense. It means their manufacturing costs basically blew up in their faces.
And the bleeding doesn't stop there. She also listed an $800,000 negative impact from cutting their ice cream business entirely, another $800,000 hit from material cost increases, and a $600,000 negative impact from delayed revenue recovery on their legacy products.
Yeah, so if we connect this to the bigger picture, you are seeing a cascading domino effect of operational failures, and all of them are stemming from one central location.
So what actually happened inside this dairy plant when Barfresh took over?
The CEO, Riccardo Delle Coste, was remarkably candid about this on the call, almost surprisingly so. He admitted that the infrastructure and the equipment at the old Arps facility were essentially overwhelmed by what they tried to do.
Overwhelmed how? Like, did they just not do their homework? Did they not know what they were buying?
Well, management claimed their due diligence was thorough, but there's a massive difference between, inspecting a piece of equipment while it's running its normal daily milk load and stress testing it by ramping up production to handle a massive influx of entirely new, different products.
Right, so they bought Arps Dairy, walked in, and basically said, great job with the milk, now start pumping out millions of our Barfresh smoothies on top of everything you were already doing.
Yeah, they started aggressively weaning themselves off their third-party co-packers.
Those are the independent factories they used to rely on, right?
Exactly, the guys who used to make their smoothies. So they started shifting all that volume to their newly acquired Arps facility.
But you can't just pour a thick, blended, fruit-heavy smoothie into a pipe designed for thin fluid milk.
Yeah.
I mean, the viscosity completely changes the pressure on the pumps.
Exactly.
The cooling systems suddenly have to work overtime to bring the temperature down. The sanitation cycles, what they call clean-in-place systems in manufacturing those, have to be completely recalibrated to handle different types of residue. They essentially tried to run a marathon in hiking boots, and the machinery just choked.
Oh, it choked hard. Delle Coste detailed that once they started running the required volumes for the school smoothie contracts, they just pushed past the limits of the infrastructure. The equipment broke down, it required constant, unexpected emergency repairs, and it just lacked the basic efficiency to run at scale.
So that perfectly explains the $1.8 million in extra processing spend. They were flying the plane while simultaneously trying to rebuild the engine midair, paying for emergency parts and overtime labor just to keep the lines moving.
And the situation deteriorated further. The facility simply could not reliably run both the Barfresh smoothie products and the legacy Arps ice cream business at the same time.
Oh, wow.
Yeah, the physical plant didn't have the capacity to handle both product lines without one actively sabotaging the efficiency of the other.
The CEO actually stated that on the call, right? That
Right.
Running both without one affecting the other became physically impossible.
He did. So management found themselves backed into a corner, and they had to make a very painful triage decision. See, the summer quarter is their peak demand season for building inventory. They have to stockpile product for the upcoming school year.
Right.
And they had an absolute mandate to fulfill those education channel contracts for their core smoothie products.
Because the B2B school market is ruthless. If you fail to deliver your product to a school district, they don't just politely wait for you to figure it out.
No, not at all.
Kids need to eat today. The district just drops you from the menu and buys from a competitor. You lose the contract entirely, and it might take years to win it back.
Which is exactly what happened to Barfresh the previous year when their third-party co-packers failed to deliver. So staring down the barrel of losing those school contracts again, they literally had to pull the plug on the Arps ice cream mix business.
They just killed an entire revenue stream.
Just shut it down. They moved the ice cream production out to free up capacity for the smoothies, and that single defensive decision cost them $800,000 in expected earnings for the quarter.
Wait, I have to push back on management's strategy here.
Yeah.
Think about the logic. They bought a dairy factory specifically to fix their broken supply chain, to take control of their own manufacturing destiny.
No.
But the equipment they bought was so old, so fragile, that they had to kill a functioning, revenue-generating product line just to keep the lights on for their core smoothies.
Yeah.
Did they just buy a lemon of a factory?
It's a critical question, and it's exactly the kind of pushback retail investors need to be aiming at management. I mean, on a spreadsheet, it looks like a disastrous misallocation of capital.
Yeah.
You buy a business, you immediately break its machinery by overworking it, and you are forced to shut down a chunk of its operations just to survive.
It sounds like a textbook case study in poor M&A execution.
It does, but if we look at it through the lens of management's broader strategic crisis, they view this entire ordeal as a defensive necessity.
Defensive necessity. Explain how burning millions of dollars in unexpected costs is defensive.
Well, think about the vulnerable position Barfresh was in prior to this acquisition. They were a beverage brand without a factory. They relied entirely on third-party co-packers. And in the post-pandemic supply chain environment, there was a massive industry-wide shortage in cultured dairy manufacturing capacity.
So the independent factories, the guys who actually owned the stainless steel vats, had all the leverage.
All of it.
They could dictate terms, raise prices, or just drop smaller clients altogether.
Exactly. Delle Coste noted on the call that some co-packers simply refused to renew their agreements with Barfresh. Other facilities physically couldn't supply the massive quantities required for the school contracts.
Wow, so Barfresh was getting evicted from its own supply chain. They had the demand, they had the school contracts, but they were homeless when it came to manufacturing.
And as a direct result, they couldn't supply their school district customers the previous year. They were bleeding hard-won contracts simply because they didn't have the physical product to put on the delivery trucks.
So acquiring Arps Dairy wasn't some aggressive growth play. It was a desperate survival maneuver to keep the company alive.
Yes, they had to internalize their manufacturing to guarantee their supply, even if the factory they bought was a fixer-upper that required millions in surprise maintenance.
That is the core argument management is making to investors. Even with the massive negative margin hit, even with the broken equipment and the sacrificed ice cream revenue, the CEO stated point blank on the call, like, the Arps acquisition was necessary to ensure continuity of supply, and that is exactly what it has delivered.
Right, so they successfully brute forced the product into existence and kept the school contracts alive, but it cost them a small fortune in emergency repairs, lost efficiency, and killed product lines to do it.
They prioritized long-term, top-line customer retention over short-term, bottom-line profitability.
Exactly.
They decided it was better to bleed cash today than lose the school districts forever.
But, the financial bleeding doesn't stop with the broken machines. We still have that $800,000 negative variance from material cost increases to deal with.
Right. Inflation on raw input costs continues to be a major headwind. The CEO noted it was somewhat of a mixed bag, like some packaging costs went down, some dairy costs went up, but when the dust settled, it was an $800,000 drag on earnings compared to the prior year.
Did they outline a strategy to mitigate that? Because you can't just keep eating raw material inflation forever, especially with negative gross margins.
They mentioned looking at product reformulations where possible to find ingredient cost savings.
So basically tweaking the recipe to use cheaper inputs without changing the taste.
Yeah, exactly. But realistically, until they get their manufacturing efficiency sorted out, those raw material costs are going to sting a lot more than they would for a well-oiled operation.
And what about that final $600,000 hit? The CFO called it delayed revenue recovery. What does that actually mean?
That goes directly back to the supply chain crisis from the previous year. Because Barfresh couldn't reliably supply product from their co-packers, schools took them off the menu.
Right, we touched on that. If you miss a delivery, you're out.
And getting back on a school lunch menu isn't an overnight process. You can't just call the principal the next day and apologize. You have to wait for the next annual bidding cycle.
Oh, because the menus are set months in advance.
Exactly. So the first half of 2026 was essentially a write-off for growth in the education channel because they were still suffering the hangover from the 2025 supply failures.
Okay. That connects the dots on why the legacy products only grew 9% this quarter. They're still sitting in the penalty box with some school districts.
They are actively winning those customers back now for the upcoming 2026-2027 school year, but the revenue from those reinstated contracts doesn't show up in the Q2 financials.
Okay, so let's summarize the operational reality of this quarter. They bought a struggling dairy factory just to save their core business.
Yep.
The integration blew up their margins, forced them to cut profitable product lines to make room. They are battling inflation, and they are still paying the price for past supply failures.
That is the unvarnished, brutal reality of Q2 for Barfresh. So the factory is a money pit, they're cutting legacy product lines, and they are stuck in the penalty box with school districts. Management couldn't possibly hide this reality from Wall Street. They had to face the music on the earnings call.
They did.
They had to slash their guidance.
Yeah, because of all these compounding factory growing pains, management had to face reality and significantly lower their financial outlook for the rest of the year. The initial projections they gave investors were just completely detached from the situation on the ground.
The revised numbers are sobering for anyone holding the stock. Full year 2026 revenue is now revised down to a range of $23 million to $26 million.
Which is still substantial year-over-year growth compared to 2025, but it reflects a much slower, much clunkier production ramp than they initially promised the market.
But top-line revenue is just vanity at this point. The real pain is on the bottom line. Full-year adjusted EBITDA is revised down to -$1 million to -$2 million.
And we need to define what that actually means for people. Adjusted EBITDA is supposed to be the closest thing to a true operating profit metric. It stands for earnings before interest, taxes, depreciation, and amortization. So it strips out the accounting fluff.
Right. It's essentially the raw cash flow generated from the core operations of the business.
Exactly. And remember, this adjusted EBITDA already excludes things like stock-based compensation for executives and one-time acquisition expenses. So for that adjusted metric to be negative $1 to $2 million means the core business of making and selling smoothies is currently burning cash.
They're projecting to lose money on an operating basis for the entire year.
Management is projecting to be roughly negative $500,000 to break even in the second half of the year, assuming they can drastically improve production efficiencies at Arps, but the full year as a whole is a complete write-off for profitability.
If the old Arps Dairy facility is this much of a headache and it's burning this much cash, what is the actual light at the end of the tunnel here? Like, how does Barfresh get out of this operational mess?
Well, the holy grail for Barfresh right now, the entire thesis of the company going forward rests on a completely new facility.
The Defiance, Ohio plant. I saw this mentioned repeatedly in the sources.
Yes. This is a brand new 44,000 square foot facility they are currently building out. Management stated explicitly on the call that completing this facility is their absolute top operational priority above everything else.
Because it's supposed to fix everything, right? It's the magic bullet that solves the capacity issues, the margin issues, and the co-packer issues all at once.
That is the narrative they are selling to Wall Street anyway. It represents a massive step change in production economics. It will theoretically have the modern capacity to handle both the smoothie products and the legacy ice cream business efficiently under one roof.
And it will finally give them total uncompromised control over their gross margins.
Exactly.
But here's where it gets deeply concerning for a retail investor, though. Building a 44,000 square foot manufacturing factory from scratch is incredibly capital intensive. How is a microcap company that only has $4 million in revenue and is currently burning cash on negative margins, paying for a massive infrastructure project?
That is the multi-million-dollar question. And the financial juggling act they are performing to pull this off is incredibly precarious.
Let's follow the money and break down exactly how they are financing this. Because in March of 2026, Barfresh secured a $7.5 million senior convertible note.
We need to explain how a convertible note functions because it's a massive risk factor. A convertible note is essentially short-term debt that can eventually be transformed into equity.
Meaning actual shares of the company.
Right.
It's a classic move for a cash-strapped microcap. You borrow money today, but instead of paying it back with cash you don't have, you pay it back by issuing new shares to the lender.
And it is often very expensive financing. And if it converts to equity, it heavily dilutes existing shareholders.
Because your slice of the pie gets smaller.
Exactly. Your slice gets smaller because the company just baked a whole bunch of new slices to hand over to the debt holders.
So they take this $7.5 million in convertible debt, bringing that dilution risk onto the balance sheet. And what do they do with the cash? They use it to pay off the existing mortgage on the Defiance facility.
Which means they now own the physical building and the property itself free and clear without a bank mortgage encumbering the asset.
Which sounds great on a PR release. We own the asset outright.
Well,
But owning an empty concrete building doesn't make smoothies. You still have to build out the inside of the factory. You need the giant stainless steel vats, the intricate piping, the bottling lines, the massive cold storage units.
and that is exactly where the red flags start aggressively popping up on the earnings call. When pressed by analysts, CEO Riccardo Delle Coste admitted that construction costs are, and this is a direct quote, a moving target. Furthermore, he acknowledged that costs have increased significantly more than they initially anticipated.
A moving target. That is absolutely terrifying phrasing for an investor to hear on an earnings call. When a CEO calls a budget a moving target, it means the budget is blown.
Oh, absolutely.
They have lost control of the final price tag.
It means they don't know exactly how much cash it's going to require to get the machines turned on.
But they don't have infinite cash to throw at a moving target. Look at their liquidity position at the end of Q2. They only have $1.4 million in cash and accounts receivable left on the books.
$1.4 million in total liquidity, and they are currently burning cash on daily operations because of the Arps Dairy inefficiencies. And they still have to finish out a 44,000 square foot factory with ballooning, unpredictable costs.
The math does not easily compute.
It really doesn't.
So how do they bridge that massive financial gap?
Management explicitly stated on the call that they will need to secure a new mortgage on the property they just paid off, along with additional specialized equipment financing to actually finish the plant build-out.
Wait, let me make sure I'm understanding this financial loop correctly. They took on expensive, highly dilutive convertible debt to pay off the mortgage on the building, just so they could turn around and take out a new mortgage on that exact same building to pay for the equipment inside it.
That is precisely the financial engineering they are executing. It is high-stakes financial leverage. They paid off the building to create an unencumbered asset. Now they are using that unencumbered asset as collateral to go back to the banks and raise the final chunk of cash needed to buy the manufacturing equipment.
That is incredibly risky for a company of this size. What happens if the credit markets tighten? What happens if regional banks look at their negative EBITDA, look at their negative gross margins and say, no thanks, we aren't giving you a mortgage on a half-finished smoothie plant?
It is the ultimate bottleneck. When an analyst explicitly asked about their financing options on the call, Delle Coste flatly stated, "We're not planning to go back to the market to raise money," meaning they aren't planning to do a secondary stock offering to raise cash right now. They're betting the entire future of the company on securing that mortgage and that equipment financing.
And there is a massive ticking clock on this entire project too, isn't there?
A very loud, very expensive ticking clock. They have a $2.4 million government grant approved to help them purchase and install the specialized dairy equipment for the Defiance facility.
Free money from the government. That sounds fantastic. $2.4 million covers a lot of stainless steel.
It does, but there is a massive catch. The grant has an expiration date. It explicitly requires that the equipment must be purchased, fully installed, and utilized for production before the end of 2026.
Whoa. Let me do the math on that. So if they don't get the bank financing approved, order the specialized equipment, wait for it to be manufactured and delivered, install it, test it, and get the factory partially commissioned by December 31st, they could lose a $2.4 million grant.
That is the direct implication of the timeline, yeah. It is a use it or lose it scenario. They are racing against the calendar to get partial commissioning of their core smoothie lines up and running at Defiance by the end of the year just to secure the grant money.
Wow.
It is a massive, high-stress operational and financial bottleneck.
Okay, we have covered an immense amount of ground here. We've dug into revenue illusions created by milk sales, exploding factory maintenance costs, slashed financial guidance, and a high-wire financial act to finish a new facility before a multi-million-dollar grant expires.
It is an incredibly dense, complicated quarter for a seemingly simple beverage company.
So what does this all mean for the person listening to this? Let's bring it down to the ground. Let's move from the company's internal struggles to the external reality for anyone holding or looking at the stock. It's time for our Talk Tickers verdict. We need to look at this data, cut through the jargon, and take a firm stance.
Well, if we connect all these data points to the bigger picture, you have to completely separate the short-term reality from the long-term potential. They are two entirely different stories.
Let's start with the short-term outlook. For the next 6 to 12 months, what is the verdict?
Short-term, this is heavily bearish.
I agree entirely. This is the ultimate show-me story right now. Management has made a lot of promises, but the numbers show they are struggling to execute.
Vertical integration, the process of moving from outsourcing your production to actually owning and operating your own factories, is incredibly capital-intensive and operationally complex for a microcap company.
Yeah.
It requires a flawless execution that Barfresh simply has not demonstrated yet.
They are actively burning cash. They are forced to abandon legacy product lines like the ice cream mix just to survive. Their gross margins have inverted into negative territory, and their entire future is completely reliant on securing future debt to finish their flagship facility while racing a December deadline.
The risk of execution failure over the next 2 quarters is exceptionally high. If those construction costs at Defiance continue to be a moving target, or if the credit markets freeze and they fail to secure that new mortgage, they are going to hit a brick wall regarding liquidity.
Right.
$1.4 million in cash does not last long when you are running a negative EBITDA operation and trying to build a factory.
So short term, it's a hard pass for me.
Yeah.
The risk outweighs the potential reward until they prove they can manage the cash burn. But what about the long term? Let's play devil's advocate. Let's say they manage to thread the needle. They get the financing, they hit the grant deadline, and the factory opens.
Long term, if you are a highly patient investor with an appetite for risk, there is a cautiously bullish case to be made here.
Walk me through that bullish thesis. Why would anyone want to hold this stock into 2027?
If, and it is a massive, existential, If they get the Defiance, Ohio facility fully commissioned and running smoothly by 2027, the underlying economics of the entire business will fundamentally transform overnight.
Because they finally own the means of production. They are no longer at the mercy of the landlords of the dairy industry.
Exactly. They will have total granular control over their gross margins. They won't be paying a premium markup to third-party co-packers. They won't be subject to the whims of the cultured dairy manufacturing shortage, where factories can just drop them from the schedule.
They can produce their own smoothies at scale, highly efficiently, under one massive roof that they control.
And if they achieve that stable manufacturing base, they have a massive proven runway for growth in the education channel. The organic demand for their twist and go smoothies in schools is clearly there.
Yeah.
Management noted on the call that they are successfully winning back the customers they lost during the supply crisis, and they are securing new bids for the 26-27 school year.
So the product market fit isn't the problem. The customers genuinely want the product. The kids like the smoothies, and the schools like the nutritional profile.
The sales team is doing exactly what they're supposed to do. The broker network they use to pitch to schools is functioning very well. In fact, their overhead, what's listed on the income statement as SG&A or selling general and administrative expenses, dropped significantly as a percentage of overall revenue because they are leveraging that broker network much more effectively now.
Right. I have the numbers here. Selling and marketing expenses fell to 12% of revenue, down from 39% the prior year. So the front of house operation, the actual business of selling the smoothies, is getting incredibly lean and efficient.
The structural problem with Barfresh is entirely back of house. It's the manufacturing and supply chain. If the Defiance facility actually solves that manufacturing bottleneck, the leverage on this business model is tremendous. With front of house costs dialed in, a fixed manufacturing base could help them quickly flip from negative margins to highly profitable growth.
So what is the final action here? What is the core takeaway for the retail investor listening to this breakdown?
The action is simple and defensive. If you don't already own the stock, stay on the sidelines. Let management take the risk.
Do not try to catch the falling knife.
Do not buy into the promise of the Defiance facility until management actually proves it is operational and churning out smoothies profitably. The execution risk is simply too high right now to bet on a construction timeline.
Wait for the Q1 or Q2 2027 earnings calls. Wait for the CEO to get on the line and say, the plant is online, the equipment is running smoothly, we hit the grant deadline, and gross margins are back in the 30% range.
You might miss the initial pop in the stock price if they announce the plant is open and running, but you are avoiding the massive catastrophic downside risk if they run out of cash or fail to secure financing before they get there.
Right.
Let management prove they can execute on this transition before you give them your capital.
That is incredibly clear. Stay on the sidelines, watch the Defiance facility timeline like a hawk, and wait for margin recovery to actually show up on the balance sheet.
It is a classic corporate transition story. And transitions of this scale, moving from outsourcing to vertical integration, are always messy, always delayed, and always expensive.
Before we wrap up this deep dive, I want to leave the listener with a broader thought, a macro concept to mull over that extends way beyond just Barfresh and their smoothie business.
Oh, the situation with Barfresh definitely highlights a much larger trend in the market right now. What are you thinking?
Well, we opened the show talking about that optical illusion, right? The tension of buying a factory to save your business, only to have it blow up your margins in the short term. And it makes me think about the broader manufacturing environment we've been living in for the past 2 decades.
The obsession with the asset-light business model.
Exactly. For 20 years, Wall Street has aggressively rewarded companies that are asset-light. The prevailing wisdom was that you shouldn't own physical factories. You shouldn't own heavy machinery or deal with union labor or maintenance costs. You should just be a brand, a marketing engine, and an IP holding company. And you outsource all the heavy lifting, all the dirty work to third-party manufacturers in cheaper locations.
And it looks absolutely brilliant on a spreadsheet. Asset-light models keep capital expenditures incredibly low, which sends returns on invested capital sky high. Investors love it because the company scales without having to buy physical real estate.
Right. Nike doesn't own massive shoe factories. They own the swoosh and the design. Apple doesn't assemble iPhones. Foxconn does. Asset-light was the golden rule of modern business.
But that model relies entirely on one critical assumption, which is that global and domestic supply chains function perfectly at all times.
And that's exactly the point of the Barfresh story. Barfresh tried to be a perfect asset-light company. They had a great brand, great school contracts, and they relied entirely on co-packers to actually make the smoothies. And what happened? The supply chain broke. The co-packers dumped them. They had the demand, but they couldn't get physical product to their customers.
They realized the hard way that being asset-light actually meant they had zero control over their own destiny. When push came to shove, the companies that owned the stainless steel vats held all the power.
So Barfresh is now going in the exact opposite direction. They are completely abandoning the asset-light dream. They are buying concrete, they are buying steel, they are buying heavy dairy machinery. They're taking on massive, dilutive debt to build a 44,000 square foot fortress just so they can guarantee they have product to sell. They are internalizing the supply chain.
It really makes you wonder if this is the start of a massive unwinding of the asset-light era.
Are we entering a new reality where small brands, companies that previously would never dream of owning a physical factory, must now vertically integrate and own their own means of production just to survive the chaos of modern supply chains?
And if they do, are investors prepared for the massive capital expenditures, the debt loads, and the short-term margin destruction that comes with that messy transition? Because Barfresh is the test pilot for this new era. They are flying the plane while simultaneously trying to build the engine.
It's a fascinating shift to watch, and it applies to dozens of companies across the market right now. Buying a bigger wallet might come with a hole in it at first. But maybe, just maybe, owning the wallet outright is the only way to make sure nobody else can take your cash. Something to think about as you review your own portfolio and look at how the companies you own actually make their products. Thanks for joining us on this deep dive. Keep your data sharp, and we'll catch you on the next one.